Welcome back to Miller Momentum. I've got an exciting episode for you today, and it's a long one. We are looking at Invesco and iShares. But before we get started, and even before we do the disclaimer, I want to lead with a request. Please reach out to iShares and look at their contact form and request them to offer IWMO or an equivalent strategy for US investors. After you watch this video, you'll know why I'm making that request. Anyway, let's get to it. Now, for the usual disclaimer, I am not a financial advisor, and this is not financial advice. The content in this video is for entertainment and educational purposes only. Past performance is not indicative of future results. Statements made are my opinions. Investing involves risk. Always do your own research. Today we're going to talk about the firms that I believe are arguably currently the two best providers of momentum ETFs for US investors, namely Invesco and iShares. By the end of this video, you're going to understand exactly how each fund these firms offer works, what they're designed to do, which isn't always how people use them, and why no single fund that's offered here is the best in all conditions, and why I'm particularly excited and a little bit frustrated about a fund that exists, that is managed by iShares, that follows exactly the right index, and that a US investor simply cannot buy, namely IWMO. Oh, how I wish we could have it, but enough about that for now. Let's dive in. Before we look at any specific fund, we need to understand what momentum actually is, because it's one of those terms that gets thrown around a lot, but the mechanics matter. If you're new to my channel, this will be fresh information. If not, you could skip forward a bit. I won't judge you, but I don't like to assume people already know this stuff. Some of it's pretty niche. The momentum factor is the observation that stocks which have gone up over the past 3 to 12 months tend to keep going up, and stocks that have fallen tend to keep falling. It's a continuation pattern. The typical implementation uses what's called a 12-1 signal. So you measure price performance over the past 12 months, but you deliberately skip the most recent month. Why skip the last month? Because there's a separate shorter-term reversal effect that goes on. Stocks that spike dramatically in the last few weeks often snap back as people sell to lock in profits. Skipping that month avoids contaminating your signal with noise. Now, Jagadish and Titman published the foundational paper on this back in 1993, and in the 30 plus years since then, the finding has been replicated across asset classes, across geographies, across time periods. It's one of the most robust and pervasive results in all of empirical finance. One of the most important things to understand about momentum, though, and this is something that trips up a lot of investors, is that it doesn't just live in large cap stocks. Momentum migrates over time. So this may be a problem for people who only hold, say, SPMO. So during certain periods, large cap stocks are the engine. During the run from 2019 through 2024, mega cap tech was the most obvious momentum story in the world. SPMO captured that beautifully. But momentum leadership rotates, as I mentioned. History shows that after extended periods of large cap dominance, mid cap and small cap stocks often become the new momentum leaders. It's just how it is. Valuations compress at the top, the macro environment shifts, and the baton gets passed to the next generation of stocks. This is why the Invesco suite is uniquely powerful for informed investors. It's the only US accessible framework that lets you place deliberate, targeted bets on where momentum is actually strongest at a given point in time. You can choose your cap tier. You can have conviction. And this brings me to an important point about SPMO specifically. Again, I want to temper your expectations relative to that recent performance history. SPMO is a well-designed fund, But if you're coming in after 2019 to 2024 expecting that same trajectory, you need to understand that the environment that created those returns may be behind us, at least for now. That's not an SPMO problem, and it's not a reason not to invest in SPMO. That's just the nature of the factor and where we're probably at in the cycle. In my view, it's best not to time size rotations and factors and all that. Rather, I focus on constructing well diversified portfolios strategically to operate across different cycles without any continual tinkering required. Indeed, tinkering usually hurts more than it helps. Anyway, Invesco's approach is fundamentally about giving you surgical access to momentum within a specific slice of the market. Each fund in their suite is anchored to a well-defined index universe. The S&P 500, the S&P 400 mid cap, the S&P 600 small cap, the S&P World X US, or the S&P Emerging Markets Index. You're not getting a blended up soup. You're getting momentum within a specific lane. The signal is a single measure for these funds. 12-month price change, skipping the most recent month, adjusted for volatility. It's clean, it's intuitive. Now, iShares takes a more sophisticated approach to the signal itself. Instead of just using a 12-month look back, MTUM and IMTM use both 6-month and 12-month return measurements simultaneously. Both are adjusted for volatility using 3 years of weekly return data, so essentially a Sharpe ratio style calculation. This is the MSCI SR Variant methodology, as it's called, and it's designed to identify stocks with smooth, persistent upward momentum rather than just whatever went up most recently the fastest. Now, neither approach is wrong per se, they're just optimized for different things. Invesco maximizes your ability to concentrate in the part of the market where you have conviction, which means you have more customizable blocks to build your portfolio. iShares maximizes the quality of the signal itself across a much broader large to mid cap universe. You can see the full range of available funds here. On the Invesco side, you've got 5 funds. SPMO launched in 2015 and now sits at around $16 billion of assets under management. XMMO and XSMO are actually the oldest funds in this entire group, both launched in March 2005, which is remarkable. But don't let that fool you because they have morphed over time, and I'll get to that in a moment. XMMO has grown to about $7.4 billion right now, while XSMO sits at around $2.4 billion. And for the international sleeve, IDMO covers developed markets ex-US, and EEMO covers emerging markets, and is perhaps the least loved fund, but as I will get to, it doesn't really deserve all of the hate that it gets. Anyway, on the iShares side, MTUM is the flagship, also around $20 billion, launched in 2013. IMTM is its international developed market counterpart, which launched in 2015, and it's now at about $3.6 billion in assets under management. So, back to EEMO though, an important footnote. Its inception date returns are calculated against its original index, the S&P Emerging Markets High Beta Index, which is a different animal from a momentum index entirely. In 2016, when Invesco became concerned about the performance of that old fund, they quietly retired it and switched the name, and EEMO switched to the current S&P Momentum Emerging Plus Index. IDMO made that same switch in March 2016, moving from a high beta index to its current momentum index. And a high beta is not really a factor that most people chase anymore because academic research has shown that it typically underperforms significantly over time. Totally different factor than momentum, so keep that in mind. And XMMO and XSMO, as we'll see on the next slide, went through even more dramatic changes over their lifetime. They weren't momentum funds at all until 2019, believe it or not. So if you're looking at long-term track record for the Invesco funds, you need to keep this in mind. Also notice the expense ratios. SPMO at 13 basis points is extraordinarily cheap for a factor fund. MTUM at 15 basis points is similarly efficient. The mid and small cap Invesco funds are slightly higher, so 35 to 36 basis points, which reflects the smaller asset bases and the higher index turnover in those universes. Anyway, let's get into the actual construction of the modern form of each fund, starting with Invesco. SPMO is the most straightforward. It starts with the S&P 500, 500 of the largest US companies, and it picks the top 100 of them based on a momentum score. That score is the 12 minus 1 month price return divided by the volatility of those returns. It then weights those 100 stocks by a combination of their market capitalization and that score. What you end up with is a concentrated fund of the S&P 500's strongest momentum names in recent history. XMMO and XSMO now follow that exact same logic. They just start from the S&P 400 mid-cap and the S&P 600 small-cap universes, respectively. And I want to call out something interesting about XMMO. So despite having mid-cap in the name, it historically tilts towards smaller names within the 400. The momentum stocks in that index tend to be the scrappier ones, the companies that have been on a real run. Worth understanding if cap size position matters for your allocation. One thing I want to flag now, though, and I'm going to talk about it again, is that XMMO and XSMO have not always been momentum funds, and this is a problem that comes up often with Invesco funds. They launched in 2005 as growth funds and went through 3 different strategies before landing on their current momentum mandates in June 2019. So we'll cover that history. It's complicated, and I hope, good golly, that I got the dates exactly right, but this is some convoluted development, so bear with me if there are any factual inaccuracies. I'm aiming to give you the gist of their historical development because that's what matters and that's what I'm going to make a point about. The particulars are not too important. It's just these funds change a lot. Anyway, on the international side, IDMO draws from the S&P World ex-US Index, excluding the US and South Korea. It takes the top 20% of that universe by momentum score, and the fund currently holds approximately 180 to 195 securities across multiple developed markets. It's a lot bigger because the world is big. The exact country count varies by rebalance, but one thing to note, turnover runs around 105% annually for IDMO, so this is a fund that's actively rotating its holdings. Anyway, EEMO is the emerging market play and gets, in my opinion, way more hate than it deserves. Same top 20% methodology applied to the S&P Momentum Emerging Plus Index, which is actually a really good index. Current top holdings are heavy in South Korean and Taiwanese tech, so SK Hynix, Samsung, Delta Electronics, the usual suspects. And as I mentioned earlier, the index was different before 2016, so treat pre-2016 data carefully. And that former index is why a lot of people think that EEMO is a bad ETF. Well, it was once upon a time. Then it changed. Anyway, now for iShares. And this is where the methodology gets particularly interesting. MTUM tracks the MSCI USA Momentum SR Variant Index. Yeah, that's a mouthful. Anyway, the SR stands for Sharpe Ratio, and that's exactly what this signal is doing. For each stock in the MSCI USA universe, iShares calculates the 6-month excess return over the risk-free rate and then divides it by the annualized volatility of weekly returns over the past 3 years. Then it does the exact same calculation for the 12-month return. It averages those two risk-adjusted momentum scores, and the stocks with the highest combined scores get selected and weighted. So why does this matter? Because raw 12-month returns can be dominated by a handful of very volatile names that happen to spike. The volatility adjustment penalizes that. What you're left with is stocks that have been going up steadily, persistently, and relatively smoothly. And that's arguably a higher quality momentum signal because those stocks are more likely to keep on rising instead of, taking a nosedive. So IMTM is MTUM's international complement, identical methodology just applied to the MSCI World X USA universe. As of early 2026, the geographic breakdown is heavy on Japan at about 21%, Canada at 16%, and the UK at 13%. The sector story here is interesting. So 37% in financials, which tells you that European and Japanese banks have been among the strongest momentum plays in international developed markets recently. One critical note for those who are wondering, MTUM and SPMO will have overlapping names, but they're definitely not the same fund. The dual period signal, the volatility scaling, the sector diversification overlay, these all result in a genuinely different portfolio for MTUM. Don't assume they're interchangeable just because both say large cap US momentum. Large cap is a very broad term, and MTUM tilts rather significantly into mid caps and away from mega caps, which is actually one reason why it's been performing a little bit less than SPMO, because SPMO has all of the shiny tech giants in it right now. That will not always be the case. Before we look at performance numbers, though, I want to go back to what I've mentioned several times already. The Invesco funds are a little bit unstable, would be a good word for it. And this needs to, in my opinion, inform how everyone interprets the performance of these funds and how investors approach the decision between Invesco and iShares overall. So you can see on this slide, we've got a table covering 5 funds across 2 groups, and I'm going to walk you through what you're looking at. So XMMO and XSMO, hard one to say, are not what they appear to be if you just look at the fund name and inception date. They launched in March 2005. But in 2005, they were growth funds. Specifically, they tracked the dynamic mid-cap growth IntelliDex index, whatever IntelliDex is. Probably something that people in the 2000s knew a lot about. I don't, but it's in the documents. So anyway, and its small cap equivalent. Quantitative indexes designed for capital appreciation, not factor momentum. Then, in June of 2011, Invesco switched them, this time to the RAFI, or RAFI, Fundamental Mid-Growth, and RAFI Fundamental Small Growth. Those were fundamentally weighted growth strategies from research affiliates. Still not momentum. In fact, kind of tilted toward a more high conviction, let's study the fundamentals of stocks type strategy. Then, in May 2015, another switch. Russell Midcap Pure Growth and Russell 2000 Pure Growth. Still not momentum. It wasn't until June 21st of 2019, 14 years after these funds launched, that XMMO and XSMO became the momentum funds you see in this deck. Only then did they start tracking the S&P Midcap 400 Momentum and S&P Small Cap 600 Momentum indices respectively. That's kind of crazy when you think about it. Now, IDMO and EEMO have a shorter but still important history. Both launched in February 2012, tracking high beta indices. Not Momentum. IDMO tracked the S&P BMI International Developed High Beta Index, and EEMO tracked the S&P Emerging Markets High Beta Index. Then in March 2016, both switched to their current momentum indices. So any performance data before March 2016 reflects a high beta strategy, not the momentum strategy you're evaluating today. So all of that historical information is trash unless you are backtesting the specific modern index. Now, testful.io does offer that modern index backtested with XMMO SIM, which if you plug it into testful.io, you'll note that it departs quite a bit from XMMO around 2005, and there's a reason for that, because XMMO was a different fund back then. Make of that what you will. Anyway, at the bottom of the table, you can see SPMO, MTUM, and IMTM. These three have never changed their underlying indices. Their since inception returns are clean and directly comparable from day one. Why does history matter? Two reasons. As I already mentioned, any since inception figure for XMMO or XSMO blends four different strategies and is basically meaningless. It is not evidence of what the current strategy can do at all. Same thing for EEMO, same thing for IDMO. They've changed. Second, there's a forward-looking question that I actually haven't seen anyone on YouTube address. Will Invesco change these indices again? Maybe. I mean, some of these former funds were extremely successful and then they decided, hey, let's try something different. Under SEC rules, ETF providers can change an underlying index with 60 days notice to shareholders. There's no contractual lock-in. MTUM and IMTM have both tracked their MSCI momentum indices since inception with no substantive change. That demonstrated stability is worth something when you're building a long-term factor allocation, and I think people don't even mention that consideration, and it's really underrated, and it's a definite point in favor of iShares. So these funds have different inception dates, different universes, and critically, some of them have completely different histories than the names suggest. So I've restricted only to the last 10 years rather than since inception for that reason, since, apart from XMMO and XSMO, all of these funds have been momentum funds since 2016. XMMO and XSMO were the last to get on board with that. But SPMO's annualized return since 2016 is real, but it reflects a specific period that included extraordinary large cap tech dominance. So I wouldn't read it as a universal momentum premium. MTUM, which has the cleanest long data series going back to 2013, has compounded at around 14% annually. That's genuinely excellent for a passive factor fund. Its 3-year annualized return of about 21% reflects its strong positioning in the recent tech cycle. IMTM's 2025 performance deserves attention. It returned more than MTUM over the past year, and that's the international rotation story playing out for you in real time. IDMO's 1-year return also reflects the strong run in international developed momentum. And XMMO shows a 1-year return of 36.5% and a 3-year of 32%. Looks like. I mean, oh no, 1 year of 36.62% and 3-year of 33.12%. Tiny type. I need to go get my eyes checked. Anyway, keep in mind though that XMMO and XSMO were totally different funds before 2019, And before 2016, you can't use anything for IDMO or EEMO. At this point, I want to make a point about momentum investing, and I'm going to use MTUM and IMTM to do it. So, looking at 2022, both MTUM and IMTM fell around 16 to 18%. That is a momentum crash. In 2022, interest rates were rising sharply. High growth tech stocks, which had been dominant momentum names, reversed hard, and the factor had one of its worst years on record, overall across most funds. This is the risk you sign up for with momentum ETFs. It is not a smooth ride, unless you pair it with value, but that's a different video. Anyway, but then look at what happened next. MTUM came back in 2023 with 9%. Then 2024 was extraordinary, 33% as AI and mega cap tech came roaring back. And 2025 added another 22%. Now look at IMTM in 2025. 34.4%. That's not bad. It actually beat MTUM in calendar year 2025. Oh, and I just realized these slides round the decimal point off, but that's okay. Concept still stands. Anyway, I need to be carefuler when I'm setting these charts up in PowerPoint and make sure that the formatting displays right. But this is actually cleaner. I like it. Sorry about the tangent. Anyway, because international markets, European financials, Japanese industrials, energy companies outside the US, and so forth, had been building momentum that finally showed up in a big way. And this is exactly the rotation story I talked about earlier, about, stuff shifting to the international stage, playing out in real data. If you're running MTUM as your only momentum position, you missed that international move. This is why I think MTUM plus IMTM, they're a great pairing, and it's important to have them together. Or alternatively, SPMO plus IDMO for Invesco loyalists. But the two together give you more or less a fairly full developed market momentum picture. And let's talk about risk now, because this is where I see a lot of investors just kind of look the other direction and whistle past the graveyard. The most important risk metric here isn't volatility, it's regime sensitivity. Momentum is a trend following factor. That's why I like it, but that's why it can hurt you if you're not careful. When trends reverse suddenly, momentum funds don't have any fail-proof defense mechanism. They're holding yesterday's winners right at the moment when yesterday's winners are becoming today's losers. The 2022 drawdown of roughly 18% for MTUM illustrates that clearly. A few things stand out in the numbers here. MTUM has a 3-year beta of 1.14 against the S&P 500, meaning it amplifies market moves in both directions. IMTM, interestingly enough, has a beta of only 0.78. Its lower correlation to US markets means it actually reduces portfolio level volatility for a US heavy investor. That's a genuine diversification benefit here. The valuation gap between these two is significant. MTUM trades at 30 times earnings and 5.2 times book value. That's the premium you pay for US large cap momentum. IMTM trades at under 18 times earnings and only 2.3 times book. International momentum is considerably cheaper, well, at least at the present. Momentum funds are shapeshifters. When value is outperforming, they become value funds. When growth is gaining, they become growth funds. And that's why when you're looking at momentum funds, the PE ratio isn't as important as other kinds of funds like value funds, because you're not going to be holding those stocks forever anyway. You're only going to hold them until they stop going up, and then you're going to switch out and hold other ones. So it's not like that has any lasting meaning for the expected returns for a momentum fund, because you're constantly turning over and embracing stocks with an entirely different PE ratio. When value starts outperforming, suddenly all of the momentum strategies' PE ratios are going to drop down to the basement because they're going to gobble up all the value stocks. That's just how they work. So I mentioned costs, speaking of turnover, but I want to reiterate it here in the context of risk. High turnover creates what's called implementation shortfall, the gap between index returns and what investors actually receive. And this is more of a concern for XMMO and XSMO because since they trade with smaller cap stocks, it's more expensive to trade on that less liquid universe. Anyway, basic thesis of the entire deck, put plainly, is no single momentum ETF is the best for all conditions, except maybe for IWMO, but we can't have that. What I believe and what evidence supports is that the combination of Invesco's suite or iShares MTUM and IMTM gives U.S. investors the most complete momentum framework available for now. No other provider comes close. Here's how I think about each one's core value. Invesco gives you surgical precision. You can decide based on your own macro viewpoint and factor research whether large cap, mid cap, small cap, international developed, or emerging market momentum looks most attractive to you. You can overweight or underweight any of those slices. That level of granularity simply doesn't exist anywhere else in US registered ETFs for momentum. iShares gives you methodological depth and scale. MTUM's dual period volatility adjusted signal is genuinely state of the art for a passive momentum fund. And at $20 billion in assets, it's one of the most liquid factor ETFs in the world. IMTM pairs perfectly with it for international exposure. The scenario table I've included is meant to be a practical reference. What are you trying to do? If you want a core large cap US tilt, MTUM or SPMO. If you've got mid cap conviction, XMMO. If the small cap cycle looks attractive, XSMO. For a complete portfolio covering both US and international developed markets, MTUM plus IMTM is my preferred pairing, or if you prefer the Invesco framework throughout, SPMO plus IDMO, even though it's a bit more restricted. All right, now let's get to the part of the video where I'm going to get genuinely frustrated. I want to tell you about what I personally believe is the best momentum ETF in the world, period, full stop. It is called IWMO. It's made by iShares. It's been beating the S&P 500 handily since inception. It tracks the MSCI World Momentum Index, which spans 23 developed markets. It has about 4.5 billion euros in assets right now, and it's been running since October 2014, so that's more than a decade of live performance. It costs 30 basis points. Pretty cheap. It's accumulating, meaning dividends are automatically reinvested. It's clean, it's well designed, it's exactly what you'd want. It can not only lean into different stocks that are doing well, it can adaptively shift geographies. And you can't have it. Not if you're a US investor watching this video. IWMO is not accessible to you through any standard brokerage account. You can find it on the London Stock Exchange under the ticker IWMO.L. You can find it on the Swiss exchange as IWMO.SW. European investors, British investors, they can buy this without any trouble. You and I in the US cannot. In a moment, I'll explain exactly why. But first, let me make the case for why this fund deserves attention even for US investors who can't own it currently, and why, after watching this video, as I said during the intro, you should totally contact iShares via the contact form or call them or whatever and request it for US investors. Firms routinely add funds that are requested by enough investors. And sometimes 10 to 20 emails or phone calls from entirely different people is all it takes for them to validate that there is interest. Anyway, IWMO tracks the MSCI World Momentum Index. The MSCI World Momentum ETF covers 23 developed countries, as I stated: the United States, Japan, United Kingdom, Germany, France, Switzerland, Canada, Australia, and 15 more. And crucially, it scores momentum across all of those countries simultaneously in one unified cross section. Here's why that matters, especially if you realize that the US stock market was not the winner of the past 100 years. It was actually, I believe, Norway and Australia. Anyway, when MTUM and IMTM run their momentum calculations, they're doing it separately. MTUM asks which US stocks have the best momentum. IMTM asks which non-US developed market stocks have the best momentum. Those are two separate calculations producing two separate rankings. IWMO asks which stocks in the entire developed world have the best momentum. Full stop. A Japanese semiconductor company competes directly with a US industrial company for a spot in the portfolio. The fund allocates globally based on where momentum is strongest, without you having to decide in advance how to split between domestic and international. It adapts organically as rotations occur between domestic and international stocks. It chases momentum across the globe. And that's the key distinction. When you combine MTUM and IMTM, you still have to decide the weights. You're saying, I want X% in US momentum and Y% in international momentum. That's a tactical decision you're making manually at every rebalance. IWMO removes that decision. It's done for you, systematically, based purely on where the signal is the strongest. And if a particular country stagnates or has a bad period, guess what? IWMO dynamically adapts and shifts away from it. Add the accumulating structure, those dividends that are automatically reinvested at no cost or friction, and you have a genuinely elegant instrument here. I find it frustrating, honestly, that it's not available to us in the United States. It's the right product for a globally diversified momentum investor. Maybe the perfect product. Really, go request it from iShares. It's got a gold quantitatively determined star from Morningstar Europe for a reason. Use iShares contact form and send them a message. I am serious. So why can't US investors buy IWMO right now? IWMO is an Irish domiciled UCITS fund. UCITS, that is. UCITS stands for Undertakings for Collective Investment in Transferable Securities. It's the European framework for investment funds. Under the U.S. Investment Company Act of 1940, any investment company offering securities to U.S. persons must register with the Securities and Exchange Commission. IWMO is registered in Ireland, structured under Irish and EU law, and has no intention of filing a U.S. registration statement. So U.S. persons, meaning you and I, watching this from the United States, are explicitly blocked from buying it. iShares says so directly in the fund documentation. I'm not paraphrasing here. Their material states that IWMO's securities may not be acquired by any person deemed to be a U.S. person under the 1940 Act. Here's the irony. European investors face the exact mirror image problem. Under EU regulations called PRIIPs, Packaged Retail and Insurance-Based Investment Products, any funds sold to European retail investors must provide a standardized key information document. U.S. ETF issuers haven't produced those documents for their U.S. registered funds because Europe is not their primary market. So a European investor can't buy MTUM just as you can't buy IWMO. Both sets of regulations exist to protect investors. Both have inadvertently created a wall that prevents each side from accessing the other's best products. Will it change? Maybe. Global ETF structure is converging. I personally hope that someday a US registered equivalent of IWMO exists. And I've already sent a request to iShares, so go ahead and send yours. Until then, MTUM plus IMTM is the closest available approximation. And as I've tried to be clear about, it's a very, very rough approximation, almost a different animal entirely, not at all an exact replica. Let me close with a quick summary of where we landed here. Invesco and iShares together represent the best available framework for US investors who want serious, systematic exposure to the momentum factor. Invesco gives you the cap tier flexibility and global geographic reach. iShares gives you the most sophisticated, publicly available momentum signal at scale. Used together, they're remarkably complete. Within the Invesco suite, remember that no single fund is the right one for all environments. Large cap momentum had an extraordinary run. Mid cap and small cap momentum are due for their time in the sun. Probably. We'll see. Markets are always unpredictable. IDMO and EEMO give you international exposure through the same discipline lens. And IWMO, I'll keep watching it and I'll keep hoping. I genuinely hope the regulatory environment evolves to give US investors access to this globally unified momentum exposure in a single vehicle, or that iShares will launch a US strategy with enough user demand. Until that day comes, the combinations I've outlined here are the best we have, and they're not bad, they're just not ideal. All sources and citations on this slide are also in the video description. I've tried to be rigorous about attribution throughout. Links to the underlying fact sheets, academic papers, and fund data, those you can Google because academic links, especially here lately, they tend to migrate. So it's better to just Google the title of a paper and look it up where you can access it and won't get blocked by a paywall or a broken link. Anyway, thanks for watching. If you found this useful, subscribe, leave a comment with questions. I read everything. I still can. This is a small channel. It may not always be, but I'll do my best to read everything that comes in. And as always, this is not financial advice. Do your own research. Oh, you thought this video was over. Welcome to the bonus content. Now we're going to take a look at SPMO's index and MTUM's index, go back into the past, and see definitively which one is the best Momentum ETF. Nah, just kidding. They're both great funds, but they have different purposes, and I'm going to break down why. Here we have a backtest of SPMO and MTUM looking at their indices going back to the year 1994. And the most obvious observation is that MTUM is typically in the lead and much higher than SPMO. If we switch to a logarithmic scale, we can again see that MTUM is typically going to come in above SPMO. That's surprising, especially for people who got in on SPMO back in 2015 and have seen MTUM's recent performance. The reason why this is that MTUM, just as I mentioned in the presentation, tilts heavily toward mid cap stocks. It has a much broader universe than SPMO. MTUM is designed to be a one and done US momentum factor equity. SPMO is not designed to be a one and done US momentum factor equity. It is designed to specifically target the universe of the S&P 500, or namely momentum among large cap stocks. Momentum is typically stronger, though, in mid cap and small cap stocks. The past 10 years have been kind of an anomaly. So keep this in mind. It's not that SPMO is a bad fund, it's definitely a really good fund. It's just that if you are looking at for a one-stop solution for all of your momentum needs and don't want to play specific cap size bets, then funds like MTUM are probably going to be a better fit for your portfolio. So don't be fooled by the siren song of SPMO's very outsized outperformance over the past few years. You could see, it closed the gap between it and MTUM very quickly. Well, that's happened before, and that was around the year 2000 with the dot-com mania. And hey, the AI stuff kind of rhymes with that, doesn't it? But look what happened to SPMO. It fell, and then it spent 13 years in the tank, compared to MTUM, which the longest drawdown for that fund was only about 5.5 years. So keep that in mind when you're making decisions about what goes in your portfolio. If you're using SPMO, you probably want to combine it with XMMO at least, or some other cap strategy, and not just concentrate into a single index. For real this time. No more post-credit scenes. Thank you for watching Miller Momentum. I hope you enjoyed today's episode, including the bonus content. Don't forget to like and subscribe and leave a comment about your favorite momentum strategy. Hey, do you think there's another offer out there that's better than iShares or Invesco? I'm open to hearing your opinion. There are other people offering momentum ETFs. There's Alpha Architect, there's Fidelity. I'd love to do another video covering those strategies as well. I will catch you next time.